Welcome back to the second episode of Cima Revisions on performance operations. We look at cost accounting systems. Under cost accounting systems, we have marginal costing and absorption costing. Now those two are two techniques to report profits. Now how do you report profits on absorption costing? Production and stock units are valued at full production cost under absorption costing. That means your direct cost and the variable production overheads are valued at actual cost, and your fixed production overhead cost is not valued at actual cost but valued at an absorbed cost. Now why do you do that? Because once the month is over, you will not get the actual electricity bill, you will not get the actual fixed overhead bills, you will get it later. So what would you do? You would calculate something called an overhead absorption rate, and using that you charge an estimated cost to your production and stock volume. Revenue minus cost of sales will give you gross profit, and then the non-production overheads are deducted as a periodic cost to arrive at the net profit. Now, as soon as the month is over, you will send this to the senior management as a profit. Now, under marginal costing, the difference is production and stocks are valued at only the variable production cost, which means there is no absorption, no estimation, it is purely actual. Then we deduct the variable non-production overheads to arrive at contribution. Contribution equals revenue minus all the variable costs. Then we deduct the fixed cost or fixed production overheads and fixed non-production overheads as a periodic cost to arrive at the net profit. Once you get the actuals, once you get the actual electricity bill, that will be different from your absorbed overhead cost. What would you do? The difference between absorbed and actual overhead cost is called over-absorption or under-absorption. That has to be adjusted in your profit, and then later on you need to recirculate it to the senior management saying this is the adjusted profit. Now even after adjusting, your absorption costing profit and the marginal costing profit has a difference. What is the difference? The stocks. In absorption costing, stocks are valued at full production cost. In marginal costing, stocks are valued at variable production cost. The difference is the fixed overhead absorption rate per unit multiplied by the stock difference between the opening stock and closing stock. Now let's look at the advantages and disadvantages of marginal costing and absorption costing. Under absorption costing, the accountants would want you all to calculate absorption costing, the tax authorities would calculate tax on that. So that is required for external reporting. Then when you are pricing for a product, you don't price the product on variable cost, you will have to always price the product on full cost plus if the customer is a regular customer. Then another benefit is as soon as the month is over, you can send the report to the senior management team immediately. But what are the drawbacks of absorption costing, which leads to the advantages of marginal costing? Now marginal costing doesn't have this confusing concept of over-absorption and under-absorption. You don't have to do those multiple calculations. Plus one main important thing. Now if you are a senior manager in organization, you are going to leave the organization this year. You want to leave with a high note. What would you want? A high profit this year and a low profit next year. What will you do? You will overproduce. Now if you overproduce, what will happen? You have a fixed cost distributed among the overproduced volume. What will happen? You are charging only a small portion of your fixed cost to this period's P&L because your cost of sale. Your sale is small, your production volume is large. Only cost of sales will be charged to this period. The balance fixed overhead cost will be carried forward to the next period as closing stocks. And this period's profit will be high, next period's profit will be low. Marginal costing, another benefit is decision making. It calculates contribution, you can calculate break even, and you can use marginal costing for various other decisions like shutdown decisions, special order pricing and stuff like that. Traditional absorption costing. Now let's say your total fixed overhead cost is absorbed using one driver, which means you are assuming that the entire overhead cost is driven by one single driver. Now is it correct? But if you really analyze your total overhead cost, only a small percentage is driven by that one single driver, which may be labor hours or machine hours, and the balance overhead cost is driven by other drivers. Take the call center cost, driven by the call center volume. Take the bill printing cost, driven by the number of bills printed. Then supply chain or processing cost, that depends on the number of purchase orders. traditional absorption costing can be used if the direct cost is very high but the overhead volume is very small. But in the modern environment, most of your organizations are machine centric and your overhead portion is fairly large. Now when your overhead portion is fairly large, if you are using absorption costing and calculating or absorbing overheads to your products, then you are doing a miscalculation. Now what should you all do? Let's say you are using absorption costing and finally you end up getting a overpriced product or an underpriced product. Now if you are getting an overpriced product, that means you will lose out on competition because your customers will move away to a competitor. But if you have underpriced product, that means you have an opportunity cost of losing your profit. And say you are unable to improve your cost by controlling the drivers, which I'll explain in the next slide. Now look at this example. You have a 2 million cost and you have two products, X and product Y. Product X volume 1000, product Y volume is 1500, and the machine hours per unit is 5 for X and 10 for Y. Overheads are charged based on machine hours. Now how do you charge it? Take the total overhead cost of 2 million divided by the total number of machine hours you have. Now how do you calculate the total number of machine hours? Machine hours is given at the unit level, per unit machine hours 5 multiplied by 1000, 5000 machine hours. Per unit machine hours 10 for Y multiplied by 1500, you are getting 15,000 machine hours altogether. 5,000 plus 15,000, 20,000 machine hours. 2 million over 20,000, 100 per machine hour. That is your overhead absorption rate. What would you do? Do the calculation at the unit level. 100 should be multiplied by machine hours per unit in X, 5. Your cost per unit is 500. Then your OAR 100 is multiplied by 10 for product Y. 100 into 10, 1000. Your cost per unit is 1000. But look at the actual scenario. Your total overhead cost is 2 million and only 800,000 out of that is machine hour driven, and the balance is driven based on the number of setups, number of inspections, number of issues, and you have a junk box also saying other overheads which you have not identified a particular activity. How do you tackle this sort of a situation? Each activity we need to take the total cost pool, or somebody has to split the 2 million among the identified activities, total cost pool, divided by the total driver value to arrive at the cost per driver. Now how do you calculate the driver value to arrive at the cost per driver? Let's look at setup cost. Setup cost is driven by the number of setups. Number of setups as in, let's say you have one batch, the number of setups would be 1. If you have 5 batches, number of setups would be 5 setups. Now how do you calculate the number of setups? For product X, the total volume is 1000, then the units per batch is 10, meaning your number of batches or number of setups would be 100. For Y, total volume is 1500, then your units per batch is 30, 1500 divided by 30, your number of batches would be 50, which means 100 batches for X, 50 batches for Y, 100 plus 50, 150 batches. So your setup cost per setup or per batch would be 225,000 over 150. Now let's look at quality testing. Now quality testing is driven by the number of inspections. Now look at the data. Inspections are given not per unit, not for the entire product, but given per batch. Inspections per batch is 2. How do you calculate the total number of inspections? 2 should be multiplied by the number of batches. 3 should be multiplied by the number of batches to arrive at the total number of inspections. 2 into 100, 3 into 50 gives you 350 inspections. Now that driver is also at the batch level. Now look at the next example, quality testing. Stores issues. Now stores issues, what is the driver? Driver is number of issues. Now they have given the number of issues for the entire product, not per unit, not per batch. So that is given at the product level. Meaning your drivers can be split into 3 unit level drivers, batch level drivers and product level drivers. For unit level drivers, you have to calculate take the unit driver per unit multiplied by the number of units to arrive at the total driver value. Then if it is batch level, take the driver per batch multiplied by the number of batches to arrive at the total driver value. If it is at the product level, simply add the driver value to arrive at the total driver value. Now should you charge it to the products? If it is unit level, batch level and product level, do the calculation in product level. Take the cost per driver, multiply it by the total driver value for product X, total driver value for product Y to arrive at the total cost of X and total cost of Y. Then finally divide it by the number of units to arrive at the cost per unit. Now this is the better way or more accurate way of arriving at the cost per unit. If you carefully observe, CPU of X under absorption costing is 500, but under activity based costing is 800. But it is vice versa for Y. X is understated in absorption costing, Y is overstated in absorption costing. Simply, if you look at activity based costing, no cost is fixed, all the costs are variable. Machining, setup, quality testing, everything is variable, but not per unit, but upon the driver. So if you change the driver value, then your cost would come down. Let's look at the advantages of activity based costing. This would lead, a better costing would give you better pricing. Better pricing would give you better demand forecasting or better strategy, sales strategy, and better decision making as well. Now look at the previous example of quality testing. If you want to outsource the quality testing department, now you know the quality testing cost per inspection, which is 1000. What would you do? From the outsourced partner, you would quote a price less than 1000. If he quotes a price less than 1000, financially it is viable, you would outsource. Then performance management. Look at the same example. If last year's quality testing team, the cost was 1000 per inspection. Now this year you want to set up a better performance target. What would you do? You set a target of 900. Now tell them to achieve 900 this year. So you can go for better performance management. Plus, you can control the cost by controlling the drivers. Now look at the example again, quality testing. Now how do you bring down the quality testing cost? That is by reducing the inspections. Now how do you bring down the inspections? First control the inspections per batch. Then control the number of batches, or bring down the number of batches by increasing the batch size. Then your quality testing cost would automatically come down. One drawback of absorption costing is it cannot be used for non-production overheads, but activity-based costing can be used. Then absorption costing cannot be used for service organizations. We can use it for service organizations here. What are the disadvantages? Go back to the previous calculation. Here you have only 5 activities, but in a normal organization you will have hundreds of activities. Yeah. In that case, who's going to identify the activities? Who's going to split the cost among hundreds of activities? Financial accountants will never ever do that for you. Then the cost driver. How would you identify the cost driver for 150, 200 activities? And who is going to collect that driver information for 100 activities, 150 activities? And who is going to upload it to a system? And who is going to design the system? Less practical. And very costly. If you bring down a consultant to implement this, you would charge a thumping amount. Then, let's say your father was a management accountant, grandfather or great-grandfather was a management accountant who was doing absorption costing. Will he ever prefer this technique? No, he will not. He will always resist this technique. And also, if you look at the previous calculation, there's a category called other overheads. Now that other overhead was unidentifiable with the activity. 150,000 out of 2 million is okay, but if that was 40% or 50%, it again boils down to the drawback of absorption costing of not identifying a proper driver for an activity. Let's take a short break, and after the break we'll discuss about variance analysis. We'll come back. Standard costing and variance analysis. Now in the PO syllabus, we have 10 variances from material, labor and variable overheads, 5 variances on fixed overheads, 3 on sales, 6 on mixed yield and quantity variances, 2 on planning and operational, which totals out to 26 variance formulas. I'll just run through material, labor and overheads. Under material, one important point to note. Now when you are getting raw materials to a warehouse, you are getting raw materials at the actual price. But the problem is, say if the variance is recognized at the point of purchasing, so now variance is calculated for the purchased kilos or purchased quantity, then how would you value your stock? In the stock, the variance is not there. You have removed the variance so that the stock should be valued at standard. But if your variance is recognized at the point of using, your variance will be calculated for the used quantity, but your stock will be still at the actual price. That is one important thing which you need to note in material variances. Then labor, another important aspect. Hours paid is not the same as hours worked, because you might have to stay idling for machine breakdowns, staff strikes, raw material unavailabilities, and all of that. So your rate variance is calculated for the hours paid, but your efficiency variance is calculated for the hours worked, and the difference is reconciled to the idle time variance. Variable overhead variances, same set of variances, but the only difference is both expenditure and efficiency variance is calculated on hours worked, not on hours paid. What is the assumption there? We assume that variable overheads are not incurred during idle time, but in labor it is assumed that it is incurred on idle time. Now look at fixed overhead variances. Very simple. Fixed overhead expenditure variance is the budgeted overheads minus actual overheads. Fixed overhead volume variance is the difference between budget and the actual volume multiplied by the fixed overhead absorption rate. One important point to note, under absorption costing we calculate that, but under marginal costing we don't calculate this, because in marginal costing we don't have a fixed overhead absorption rate. Now the volume variance is subdivided into two variances, efficiency variance and the capacity variance. Efficiency variance is the normal efficiency variance formula, where you take the standard hours at actual volume compared against the actual hours. But capacity variance is a new concept. Now let's say your organization has 1000 budgeted hours, but you have worked for only 900 actual hours and you are very efficient also. But that doesn't mean that you are running at full capacity. You are underutilizing your capacity. So if your actual hour is less than your budgeted hours, your capacity variance is adverse. Move into sales variances. Sales price variance is simply the price difference between standard and actual multiplied by the actual volume. Sales volume variance, you have volume profit variance and the volume contribution variance. Simply it is the volume difference between budget and the actual multiplied by either profit per unit or contribution per unit. Profit per unit under absorption costing, contribution per unit under marginal costing. Now let's look at the important aspect of the reconciliation statement. In the reconciliation statement, you have to reconcile the budgeted profit against the actual profit. Very important point to note, there are 4 scenarios under reconciliation: absorption costing, marginal costing. Under those two also, when stocks are valued at standard, when stocks are valued at actual. Now when stocks are valued at standard and actual, your final profit will differ. Now that difference in profit is adjusted through the material price variance. Why? If the stocks are valued at standard, your material price variance is calculated for the purchased quantity. But if the stocks are valued at actual, your price variance is calculated for the used quantity, right? Under marginal costing and absorption costing, the difference in profit is, as I explained to you all before, is because of the difference in opening stock and closing stock multiplied by FOAR. Now if you look at the fixed overhead volume variance, that is not calculated in absorption marginal costing, but that is calculated in absorption costing, and that difference is adjusted to the sales volume variance, because in marginal costing volume variance is calculated for contribution per unit, or you take the volume difference and multiply by the contribution per unit. In absorption costing, you take the volume difference and multiply it by the profit per unit. Now let's look at cost reconciliation, a very important thing. 2 important points to note. Some students, they reconcile the budgeted cost against the actual cost. You won't get the answer. You have to reconcile the standard cost at actual volume against the actual cost. Another important point to note is, if your variance is favorable, you can't add the variance. You have to deduct the variance. Why? Because if a cost variance is favorable, that means your actual cost is less than your standard cost. So if you have a favorable variance, deduct; adverse variance, add. Now let's look at advanced variance analysis. Mixed variance and yield variance. Now look at this example. Say you have raw materials A, B and C mixed in the ratio of 5 kilos, 2 kilos and 3 kilos. 10 kilos to arrive at a final output of 8 kilos. So what is your yield? An 80% yield. That is your expectation. But if you look at your actual total volume is 10,000 kilos. Now is it mixed in the same ratio? No, it is not. If that was mixed in the same ratio of 5:2:3, raw material A ideally would have been 5,000 kilos. But you are using 6,000 kilos. But that is compensated with a lesser volume of B and C. Now look at A. A is only $10. B and C are worth $25 and $20. A is cheap, B and C are expensive. What have you done? You have used the cheaper material more and the expensive material less, so that you will get a lesser input cost. That is called the mix variance. Now here the mix variance is favorable. Look at your output. What are you getting out? Your mix variance is favorable, but your output is not as high as 80%, but your output is only 78%, which means on the yield side, you are losing out on 200 kilos. So your mix variance is favorable because you are using a cheaper material, but your yield variance is adverse. But mix variance is 11,500 favorable, yield variance is only 4,000 adverse, which means your strategy has worked. Your combined variance is favorable. Now let's look at the sales volume variances. Budgeted volume is 4,000 and your actual volume is 6,000. Calculate the volume variance, volume difference multiplied by the standard margin. Now you will have a problem. Why? Your actual volume is 50% higher than your budgeted volume, still your profitability is 5,000 less. Why? Because of this. Even though your volume is high, now look at the mix in your budget. 13% A, 38% B and 50% C. But if you look at your actual combination, you are selling more of X and less of B and C. If you analyze A, B and C, A has a very low margin, B and C has a very high margin. So you are selling more of a less margin product and less of a high margin product. Quantity variance is highly favorable, 110,000, but the mix variance is even higher adverse, resulting in a combined adverse variance. Planning and operational variance. Now let's say your standard is set at 25, but your actual cost is 35. By the outset, your team has not performed well and they are getting an adverse variance. But standard of 25 is because of a planning mistake by the planning team. They finally figured out that the standard could have been 40. Now, is it a real operational variance? No, not an operational variance. The operational guys have worked hard to achieve this cost per unit of 35. Now they shouldn't be penalized for this. They should be actually rewarded for this because they have brought down 40 to 35. But the planning guys, they have to be penalized for their planning mistake. Now, planning and operational variances, how do you calculate? I am not going to go into details, but look at the hierarchy. Total variance is cascaded down or broken down into planning variance and operational variance. Then planning variance is cascaded down into price planning and usage planning. Operational variance is cascaded down into price operational and usage operational. Now some students, they tend to think that the total variance has to be broken into price variance and usage variance, then from there cascaded down to planning and operational, which is wrong. Why? When your price is revised, it is impacting your price planning variance, price operational variance, as well as the operational usage variance as well. And if you look at the formula, in the operational usage variance, instead of using standard price, you have to use the revised price, which means your price revision gets impacted on your operational usage variance as well. Now, why do you need to calculate planning variances and operational variances? Mainly, if you set the standard before the government budget, and government budget, they are implementing some changes, fuel prices going up, tax changes and all of that. Because of that, even though the operational guys are working hard, their performance is not getting reflected. So we need to adjust for the macroeconomic changes and reward for the actual operational efficiency. Then you shouldn't penalize or reward the operational people for planning errors. And you might end up giving a bonus for lazy set of people also. And finally, your planning team also has to be evaluated whether they have planned well or not. Now if you calculate the planning variance, next time they will be really careful when setting the standards. Now you might think that planning variance being favorable is good. No, planning variance being favorable is also bad, adverse is also bad. It should be ideally 0. So that's it on variances. We'll take a short break. After the break, we'll discuss on modern management accounting. Welcome back. Modern environment. Now we'll look at the differences between the traditional environment and the modern environment. In the traditional environment, most of the people, they were okay with standardization. They were following people. Even when they buy a shirt, they would buy somebody else's shirt when the design is the same. But in the modern environment, the younger generation, they would want customized their own products. Now because of that, the manufacturing process also has to be changed for shorter production runs, shorter production life cycles, and they would always focus on giving best customer service, best quality, whereas in the traditional environment they were producing in bulk and they were going for economies of scale. Now when you hire an employee, since you are doing the same thing, you will hire employees who are having a standard set of skills. But in the modern environment, you will always hire multi-skilled employees who can cater for a lot of requirements. Now in the traditional environment, when you are manufacturing, you always keep a provision for normal loss. But in the modern environment, you will go for just in time, 0 defects, and you would want to get it right first time. And say distribution channels, those days if you have a distribution channel, it is my own distribution channel. If you have an asset, it is my own asset. But in the modern environment, you would be willing to share your assets with your competitors, even partnering, and your boundaries will be blurred also, just in time. Now wonderful concept of a ship. You are the captain of the ship, running the organization very smoothly in the sea. Now you are running smoothly in the sea when you are having really good times, right? Why? When you are having good times, your revenues are high and you can play around with the revenues. Even the staff goes on strike, you will be okay. Machine breakdowns, you will be okay. Employees lazily they stay at home, they are okay. Suppliers would say that I won't be able to supply to you for 10 days, 15 days. You are okay because you have stocks and you can cater for that. But in the long run, what will happen? Say a bad time occurs, then stocks will not be enough to cater you all, and underneath you have a lot of inefficiencies, loopholes which you cannot correct overnight. What is the solution? Just in time. Eliminate your non-value adding activities, remove your stocks. Stocks as in raw material stocks, work in progress stocks, and finished good stocks, so that your inefficiencies will start visible, or you will start seeing the inefficiencies before a bad time occurs. Then you will flatten the inefficiencies so that even if the stock level comes down, even if you get a bad time, you can survive during the bad time. How would you reduce raw material stocks and survive? You need to maintain a really good relationships with your suppliers. How would you do that? For that, your system has to be connected to your supplier system through an ERP2 system, which I'm not going to detail. And that link has to be there, which is called an electronic data interchange. Then work in progress stocks. How would you minimize work in progress stocks? Now whenever you have half completed work in progress running up and down, there should be a streamlined process to quickly move it from one process to the other. In Japan, they have something called Kanban systems, which would be a good signaling system to minimize the work in progress stocks. Then finished good stocks. Now how do you cater for finished good stocks? Say the customer. Suddenly a customer comes into you and says, I'm going to get married in 2 days time suddenly, and I want my wedding suit done in 2 days time. Now if you are having a just-in-time system, how do you cater for that? Your staff should be culturally flexible to cater that sort of a need. And also your customer base, you should identify the customer base and maintain a good customer base, a good relationship with the customer base, so that those sort of ad hoc requirements will not come very often. What are the benefits of just-in-time? Mainly warehousing cost would come down. At your home, if you have a fridge, That is your drawback, because if you have the fridge, you will keep on consuming from the fridge, but the day the fridge is taken off, then you will realize how much you are consuming on a daily basis. Warehousing cost would come down, your inefficiencies would come down, inefficiencies would be visible and you will act on it, and then your money tied up in stocks also will be less. Three main advantages: you will have good relationships with your suppliers, good relationships with your customers, plus you will have a really flexible workforce. But problems: you are over reliant on your suppliers, customers and employees. And also, to cater just in time, you need to incur a high initial cost or capital expenditure for a flexible manufacturing system, ERP system. Plus, for just in time to cater ad hoc needs, you will have to order multiple times and your ordering cost also will increase. Now, this is very difficult if your geographical spread is very high, you can't cater just in time. Now, total quality management. In an organization, you have 4 quality related costs. Now, what do you mean by quality? Catering a customer a fit for purpose product. What are the 4 costs? Prevention, appraisal, internal failure and external failure cost. Now, what do you mean by prevention cost? That is a cost incurred to prevent junk from coming into the organization. What do you mean by junk here? Junk employees, junk machines, junk raw material and other junk stuff. What are the costs? Designing cost, training cost, testing cost and all of that. Then appraisal cost. Appraisal cost ensures that during a manufacturing process nothing happens and a defect doesn't go out. Quality inspection cost, quality control cost, those are appraisal costs. But if a defect comes out, to prevent that defect going to the customer. Now, what are those? Those are called internal failure costs. Example, cost of rework, re-inspection cost, giving discounts to customers and disposing of the rejects. But if a rejected product goes into a customer, you will be at a burden. Why? The customer complaint cost will go up, warranty cost will go up, replacement cost will go up, and majorly the goodwill will be tarnished. TQM believes that spending on prevention and appraisal cost, which is called conformance cost, is far cheaper than spending on correcting a defect or spending on internal failure costs and external failure costs. Now, those two are called non-conformance cost, which leads to the principle of TQM: prevention is far better than correction. Now, total quality management. What do you mean by total? Now, when your organization has a quality related team, you expect the quality related team to handle quality and rest they will not worry about quality. That is not the case. Total means the entire organization starting from the CEO has to work on quality. But what do you mean by management? Now, you can't just harp on quality all the time and just say we are working on quality. You have to document saying this is quality and this is not quality and act upon quality. Now, zero defects is something which a quality management system works on, and for that you need to believe in getting something right first time, having a quality control system and improving yourself continuously. Next concept is called environmental costing. Now, when you are running an organization, unknowingly or knowingly you might incur carbon emission costs, use of energy, use of water, and when you are making employees stressed, that is also damage to the society. Damage to society is a cost to the society. But how do you prevent from reducing the damage to the society? You might end up recycling certain products, or you might end up paying penalties, doing some improved checks in your systems, so that your external failure costs or your societal cost would come down, but your cost would come to your P&L. Penalties, taxes, permits are hitting your P&L. So you're preventing societal cost, but the cost is carried forward to your P&L itself. What are the advantages? The brand image. You can harp on this saying you're minimizing the external cost by taking a hit on your P&L. Your brand image goes up. And your cost is also saved because you're doing recycling, and it would lead to cost efficiencies. And you are doing fairer costing and fairer decision making, and also later on, if you are doing a societal damage and people will not recognize you for that, then your brand image will be tarnished in the future, which is saved through incurring an internal failure cost. Now what are the disadvantages? It takes a lot of time consuming, very subjective, and it is costly to implement also. And let's say the competitors, they are not implementing environmental costing. His costing is low, your costing is high, so that your pricing is also high. Then the customers might move to them. We'll take a short break, and after the break we'll discuss working capital management, the last syllabus. Welcome back. Working capital management, working capital cycle. Now let's say you are running a buying and selling company. If you buy some good, it takes 50 days for you to sell. That is called inventory days. But as soon as you sell, your customers will not pay you. If they take 70 days to pay, that is called receivable days, which means from the time you buy your good until you receive your money, it takes 120 days in total for you to get cash. But if the supplier says, I want money in 90 days, then you have a cash shortage of 30 days, which is called the working capital cycle or working capital deficit. Now how do you correct it? Either reduce your receivable days by giving an early settlement discount, or else handing over your receivables to a third party and obtaining money, that is called factoring, or else reducing your selling time, right, or reducing your inventory days. Or else you can tell your supplier, I need some extension, I'll pay you something extra. That is called the delay in payments of payables. If none of those options work, you have to go for a bank overdraft. Inventory management. Cost of stocks. Now let's say you're ordering in small quantities. When you order in small quantities, during a period you have to order multiple times, so that your ordering cost would go up. Ordering cost is the ordering cost per order multiplied by the number of orders. But let's say your order size is small, your ordering cost is high, but your warehousing cost is small, or else your holding cost is small. So those two are trade-offs. These two move in opposite directions. When you try to minimize your ordering cost, your holding cost would go up. When you try to minimize your holding cost, your ordering cost would go up. If you look at this diagram, when your batch size increases, your ordering cost would come down, but your holding cost increases. We need to minimize the total. Look at the total. The total cost comes down initially, but increases eventually. There is a minimum cost point. We call it the economic order quantity. You have a formula, you can obtain the answer. But at the exam, you need to note that the examiner would test on quantity discounts. Now let's say your economic order quantity is 6,000 and your discounted quantity is 10,000. At the economic order quantity, you are calculating a total cost, then your stock related cost increases at 7,000, 8,000, 9,000, but at 10,000 you are getting a discount. Now when you are getting a discount, your total cost comes down. By how much will it come down? Will it come down below than the total cost at the economic order quantity? If it is less, then go for the discounted quantity. So how do you do a calculation? Calculate the total cost at economic order quantity, then calculate the total cost at the discounted quantity. What is less? Go for that. Receivable management. Now this is a trade-off between credit sales and cash sales. If you give or sell more on credit, then what will happen? Then your sales would go up because the customers will be queuing up on you, and your shelves would be empty, your revenues would go up, your profit would go up. You would tend to think that your strategy works. Strategy has worked because your profit, revenue, shelves are also getting empty. But if the customers won't come back, if the customers won't pay later on, you will get a bad debt. And it will be too late when you recognize the bad debt that your OD balance will be high, you're on loans, and you won't be able to pay that. This situation is called over trading. On the other hand, if you sell more on cash, then what will happen? Your sales volume will shift to a competitor. And if the competitor gives better credit terms, customers will move to the competitor. Now how would you control credit? Now, if you are giving on credit, first assess the credit worthiness. Will he pay you? How? You will have to obtain bank references. There is something called the Credit Information Bureau or the CRIB. If the customer has not settled his credit card bill, then his name will appear in the CRIB. You can check on the CRIB, you can get trade references, look at police reports, look at legal reports. If it is a company, look at financial reports, credit rating, or else if you have a good, well-trained credit control team, you can physically go and visit. Now, for effective credit control, you need to have a well-trained credit control team, a muscular team who will go and attack and collect your money. Then there should be a proper credit control procedure. You should first remind through telephone, SMSs or emails. Then if it doesn't work, then go for blacklisting. Blacklisting means if you're not paying your mobile bill, on the other hand your TV will get disconnected or your internet will get disconnected. But even that doesn't work, then go to a third party debt collection agency, or else finally take legal action. But your credit control process should be very flexible. Let's say you have a girlfriend and you are using a couple SIM. Suddenly your girlfriend, your affair breaks up and your girlfriend doesn't settle your telephone bill. You will have to be penalized. You won't be able to watch TV, you won't be able to use internet. And so companies has to cater for that kind of flexibility. Then your monitoring mechanism of bad debt also should be good. That is called age analysis. Now what do you mean by age analysis? To identify the overdue customers at the correct time. Now, why do we do age analysis? You can measure the efficiency of your collection team through age analysis. You can assign or set targets for your credit collection team based on your age analysis, and also based on age analysis you can use that for bad debt provision. Sources of short-term credit. Now there are two sources of short-term credit. One is called early settlement discounts, the other one is called factoring. I'll straight away jump into factoring. Now factoring is to hand over your receivables to a third party and obtain money from him upfront. Now there are two forms of factoring. One is the factor will collect money from the customers. That is called without recourse factoring. That means no comeback factoring. If the customers won't settle you, no problem, tata bye, the factor won't get money. But with recourse factoring, the customer will settle you and you will have to settle the factor. Now in without recourse factoring, the service is like an insurance service. Now there are three services which a factor provides. One is the loan service, for which an interest is charged. Second one, the credit and collection service, for which an X% of revenue is charged. Then without recourse factoring, which is the insurance service, for which an additional service is charged. What are the positives? Now if you are running a small organization, you can't have a credit control team. In that case, hand it over to a third party and obtain it. But later on, say if your company grows, you will be stuck with the factor. Now take a mobile company, bills are settled through Cargills. Cargills is a factor for them. Now when the company is small, better to obtain or get your collections through Cargills. But now, why do you want to pay a higher percentage of your revenue to Cargills? Something like that. What are the other negatives? If you collect money through a third party, then the customers will be really unhappy because the service is from a third party, not from you. And who will assess the creditworthiness of the customer? It is not you, it is somebody else. And how they will assess, you are also not so sure. Move into some exam tips. Reading time, very important. Reading time should be effectively used for your MCQs. Don't read the entire question paper because all questions are mandatory. 1.1 to 1.5, do the MCQs during the reading time at least, so that you are 10 marks ahead when the paper is given. If it is a theory area, read the question carefully. If there is an AND component, select that AND component, highlight that AND component. The question will have two parts. Yeah, some students tend to answer the first part and come home. Then the bold verb in the question. If it is a state for 4 points, then you have to write only a one-liner or 1.5 liners, but you need to write 4 points for 4 marks. But if it is a explain for 4 marks, you can escape by writing 2 points, but the 2 points should be written extensively with examples. Section C. Most importantly, don't panic. calculation takes only 15 minutes or 20 minutes. The remaining 25 minutes is for you to read the question, understand the question, apply TQM here, get it right first time, don't make a mistake, because if you make a mistake and try to correct it, that will be the end of you. And section B. Most of the students, they get stuck in section B for a long period of time. Don't do it. Leave 1.5 hours for section C. Stop section B at 11 o'clock so that you have 1.5 hours until 12:30. Lastly, when you are studying during the next couple of days, don't ignore any section, because last time I saw this in November 2013 that a lot of students, they ignored working capital management, but they wanted to pass through section A. Practically impossible, because 16 questions or 16 marks out of 20 were from working capital management and students flunked. So that brings us to the end of the session. Hope you have a wonderful 2 hours of revision. I am Yushan Gunatilaka signing off. Wish you all the very best for the exam. Catch you later. See you all. Thank you.